Hello, I'm Dan Harris, Chief Operating Officer at the CE Shop. As an independent real estate professional, you're required to pay self-employment tax. This means filing for taxes will be more complicated, and your income will take a bigger hit. To offset this, it's important to take advantage of all available deductions and stay on top of your record keeping throughout the year. Before we get into deductions and record keeping, let's first go over what self-employment tax is and how it differs from standard employee taxes. Independent contractors must pay self-employment tax and file Schedule SE Form 1040 if their net earnings from self-employment income are $400 or more. With typical payroll deduction, the employer and employee each pay half of what's owed to the government for Social Security and Medicare. But with self-employed individuals, the taxpayer is both the employee and employer and is therefore responsible for the entire amount. The self-employment tax is in addition to any federal, state, and local income taxes owed, which is why your tax hit may be bigger than you expect. Because no employer is withholding income taxes, licensees should make tax payments based on their quarterly estimated tax liability. Due dates for quarterly taxes are in April, June, September, and January. The dates shift from year to year. Because taxes aren't removed from commission checks, you should plan to set aside 30 to 35% of your income for taxes. Licensees who fail to pay enough of their taxes through estimated tax payments may be charged a penalty. Enacted in 2015, this act added support to small business growth by allowing business owners to depreciate certain capital expenditures in just 1 year instead of over multiple years. By making changes to the IRS Section 179, agents receive some additional tax relief when it comes to business-related purchases. To get the most out of your taxes, here are several tax deductions that you should not overlook. Keeping diligent records on the following activities will help you save money and reduce what you owe to the IRS. Keep in mind that to qualify as a deductible, your real estate business expense must be ordinary and necessary, directly related to your business, and a reasonable amount. Home office deduction. These deductions are based on the percentage of the home that's devoted to business use. To be eligible, the area must meet the following criteria. It must be used for regular and exclusive business purposes, no laptop on the kitchen table. Also needs to be a principal place of business. Note, if you conduct business at a location outside of your home, but also use your home substantially and regularly to conduct business, you may still qualify for a home office deduction. Taxpayers taking a home office deduction may deduct home office expenses using either a simplified method or regular method. For more information, here is a comparison of both of those methods. The standard auto deduction. The IRS sets a standard mileage rate each year that accounts for gas, wear and tear, and other driving expenses. For 2020, the mileage rate was 57.5 cents per mile, down from 58 cents in 2019. Office supplies and equipment. All office-related expenses that are needed to run your business, from smaller purchases like pens, staples, and printer ink, to larger purchases like fax machines, copiers, and computers. Software and business tools. Any off-the-shelf software needs to run your business. Software like your CRM tool or even products that help you automatically track your expenses and mileage. Marketing and advertising expenses. Any advertising expenses are covered by this deductible, including marketing materials like yard signs, brochures, and photography, as well as digital and online advertising. Licenses, membership, and insurance. This section covers your license renewal, professional memberships, and MLS dues. It will also cover your general business insurance and errors and omissions insurance. Now that you understand which deductions to look for, it's time to focus on your record keeping. Meticulous record keeping is crucial, especially in the event of an audit. It's important that you keep track of and document the following: gross receipts for income, purchase records, expense reports, travel and transportation receipts, and asset records for any property that you own and use for business purposes. There's no need to wing it when it comes to something as complicated as taxes, especially when you have other responsibilities. If you're unsure about which deductions you can take or how to fill out a tax form, talk to your tax advisor. You may be wondering, how do I pick a tax advisor who's right for me? Per the IRS, here are a few points to keep in mind if you do decide to hire outside help. Check the person's qualifications. Ask about service fees. Make sure the person is accessible. Review everything they give you. The IRS even provides a list of qualified tax preparers on its website. Google Choosing a Tax Professional Internal Revenue Service. The self-employment tax can be quite intimidating at first, but with careful and regular record keeping and the help of a qualified professional, you'll be able to capitalize on the available deductions and save money for your real estate practice. Taxes are complicated, and you're a real estate agent. You have bigger fish to fry. But taking control of your taxes, even if that means handing over the reins to a qualified tax preparer, can help you keep more of your hard-earned commissions come tax time.